Okay, we are now live. I'll leave it open for a minute and allow people to join, and then we can go ahead and get started. All right, I see him rolling in. I'll give it another minute. All right, great. And I'm sure people will continue filling in as we get started here. Just make sure we're leveled off. All right, like I said, I'm sure people will keep coming in. We'll go ahead and get started. Good afternoon, everyone, and welcome to our Q2 2023 Financial Outlook and Portfolio Strategy Update. We appreciate you joining us this afternoon, and we hope to provide you with an informative presentation today, as Steve always does. If you have any questions, please feel free to put them in the Q&A feature, and we will get to them as many as we can. And with that, I know there's a lot to discuss today. Steve has plenty of updates to present. So with that, I'd like to introduce Steve Galli, our Senior Investment Officer, to take it away.
Thank you, Katie, and thank you all for joining us today. This is another quarterly portfolio update. As usual, we will try and keep it brief but informative and also entertaining all at the same time. And of course, as always, feel free to send feedback about any type of things you would like to see in case I miss anything that you feel I should have covered. I also want to mention that I know in the invite we said we'd be having a guest speaker from MFS, or better known as Massachusetts Financial Services, but unfortunately that guest speaker is not able to join us today, so I will have to go it on my own. Hopefully that's not too disappointing to you. I'll still try and do my best to keep it entertaining. So there's a lot going on out there since we did one of these last broadcasts. So we're going to go through all that, what's happening out there in the financial markets, what does that mean for what we're doing with portfolios and investment strategy, and we will open it up to questions at the end. So before we begin, in honor of the tax season being over, at least for most of us, and by the way, that's one of the reasons that we do this presentation a little later in the month. We actually deliberately do that in the month of April because, of course, we're all busy being crazy during the tax crunch time, which is mercifully over. So in honor of the tax season being over, I thought we'd do a little tax trivia to warm up. So interestingly, in the late 1600s, England actually passed a tax to extract more revenue from the wealthy. And interestingly enough, they did it on homes and specifically windows. So in other words, they decided, well, if you have a big home, you have a lot of windows, so we're going to tax you based upon the number of windows that you have. That kind of backfired because, and these are some shots of buildings that existed in those days. What did people do? Well, they promptly bricked up a lot of their existing windows so that they wouldn't pay the extra tax on that window tax that England passed. So that's a classic example of unintended consequences. And actually, it caused a bit of a public health issue because, you know, a lot of buildings therefore had less ventilation because the windows were all bricked up, and that obviously wasn't good for diseases and germs floating around. So thought that was pretty funny. How about this? For all of you geography buffs out there, hopefully you know what state is highlighted in that picture. That is the great state of New Mexico. So why are we pointing out New Mexico? Well, interestingly enough, New Mexico has a very unique tax law in that anyone who is 100 years old or older in New Mexico are automatically exempted from the state's income tax. So there are your happy caricature of 100-year-old people and up. and they don't get to pay New Mexico state income tax. So not a bad benefit for all those people who managed to make it till then, who live in New Mexico. And how about this? For all of you who don't know who that is, and this is not really my bag in terms of musical taste, but that's Willie Nelson, pretty famous country singer. So why are we featuring him on Tax Trivia? Well, in the early 90s, and actually 1992, Willie Nelson had a very unusual settlement with the IRS. He actually made an album which was called the IRS Tapes to cover his tax debts that he owed. And there actually is the album itself with the name, the IRS Tapes. So that's pretty interesting, right? Obviously, he clearly didn't have a good financial advisor, or else he wouldn't have gotten into trouble with the IRS in the first place. So anyway, that rounds out our tax trivia. Hopefully that was somewhat entertaining. So lots of headlines that we see out there. Here's one from a few days ago in the Wall Street Journal. The downgrade of regional banks. A lot of stress in the banking sector right now. We did have a couple of banks already fail. As a matter of fact, Silicon Valley Bank was the second largest bank failure this country has ever experienced, which only happened, in the first quarter. We also had another bank failure after that, Signature Bank, and we may have another one soon to come. So obviously, bank stress as a result of the rapid rise in interest rates. And a lot of this has to do with what's going on in the bond market. When interest rates go up so fast, that tends to break things. So hence this headline from Bloomberg about bond traders waiting for the Fed to break more things in the system. Bed Bath & Beyond, rest in peace. They're filing for bankruptcy. Another big box retailer that didn't make it. Certainly the interest rate environment didn't help them with their financing. So that's sort of unfortunate. So a lot of things going on out there that seem kind of negative. We actually just had a first quarter print on what the economy did in the first quarter, and actually came in under analyst expectations. People were expecting the economy to grow, give or take, around a 2% annual rate in the first quarter. It actually grew about less than half of that. So clearly not good economic numbers in the first quarter. So what did happen in the first quarter in terms of the markets? Well, this is a snapshot of pretty much every sector, stocks, corporate bonds, government bonds, and alternative assets. And as you can see, first quarter results in all those asset classes were pretty darn good, especially international stocks. Now, I know we've been beating the drum about how important it is to be diversified and how important it is to have international exposure. And that was certainly a good thing to have in the first quarter. The EFA means the Europe, Australia, and Far East Index. That was one of the best performing sectors in the equity markets in the first quarter. But pretty much strong performance across the board, both in any type of bond, whether it was high yield, whether it was corporates, whether it was munis, whether it was governments. You were okay in the first quarter. And that obviously compares pretty favorably to what the absolute one-year returns were over the last year. And as you can see, pretty much everything is still negative on a one-year basis, with the exception of municipal bonds, which barely eked out a gain over the last year through the end of the first quarter, and Japan. So not bad in the first quarter, although it was a wild ride. So what do I mean by that? Well, if people remember, in January, things started off with a bang. As soon as January started, we had the markets take off like a rocket. But then we had some disappointing earnings reports. We had some disappointing economic reports, and things started to slow down. February was kind of the not so fast. Let's not get ahead of ourselves. We had the Fed continue to increase interest rates. We had upsetting inflation numbers, which came in higher than expected. And then we also had comments that the Fed might consider hiking more than the market thought they were going to hike. So that was trouble. And then, of course, in March, we had what we were just alluding to before. We had the banking scare, or almost a mini banking crisis, I would call it. Silicon Valley Bank started announcing some trouble. Credit Suisse actually announced a lot of trouble, and now Credit Suisse has been absorbed by the other largest bank in Switzerland, UBS, or the Union Bank of Switzerland. And we now have stress in First Republic Bank. That's showing up not just in March, but also this month. So that's kind of it's been a topsy-turvy first quarter. So it's pretty amazing that the markets managed to survive all that, and we're still positive after all that activity. It's hard to believe that all happened just in the first quarter, but it did. And what's behind a lot of that dramatic movement? Well, in a nutshell, interest rate hikes. So the real question is, is the continued rise in interest rates nearing a peak? Have we gotten there? So if you take a look at this chart, this actually shows global short-term policy rates for multiple regions in the world, not just the US. So the blue line is the US. And so the blue line shows the Federal Reserve fund, the short-term funding rate since 2007, which, it was pretty high during the great financial crisis. And then it came down immediately during the financial crisis and stayed that way. The Fed started to try and hike back in 2016, and they quickly had to abandon that path as soon as the pandemic hit. And again, they cut rates back to zero until, of course, last year, when they began a very aggressive rate hiking campaign, and they were not alone. The UK, the United Kingdom did that as well, as did Germany and other parts of the world. So everyone was pretty much hiking rates with the exception of Japan. And the real question is, are we done with that? The bottom line is the US may be done. The next time the US, the Federal Reserve meets is on May 3rd. And right now the market is assigning about an 85% chance. And how do you come up with that? Well, that's determined by the interest rate futures market. And the interest rate futures market now assigns about an 85% chance that the Federal Reserve will raise rates again on May 3rd by 1/4% or 25 basis points. After that, many people feel like, and the odds are that the Fed will stop raising rates and may have to cut by the end of the year. That may or may not play out, so that'll be interesting to see how what happens. But there's going to be a lot of data that the Fed gets in between those times in terms of inflation, in terms of unemployment, which will help decide whether or not they truly are done, if indeed they do hike one more time May 3rd. So I think this is kind of interesting to look at our yield curve. So what's the yield curve? Well, this is a chart of US government bond rates by maturity. So the bottom part of the graph is the maturity. So it starts at 1 month and goes all the way out to a 30-year maturity. And this was 2 years ago. And this is what you would normally expect to see. Now, that being said, interest rates were still quite low 2 years ago. I mean, even if you had a 30-year treasury bond, you weren't barely getting above a 2% return if you bought that bond, which is, not that exciting. But if you bought a 1-year treasury bond, which I'm circling right now, I mean, you barely got 0.1% on that bond. So really, when interest rates are close to zero, bonds really weren't that exciting. Right? So this was 2 years ago. You weren't getting much bang for your buck if you bought a government bond. What about a year ago? Well, we still had a somewhat normal looking upward sloping yield curve. But now if you bought a 1-year bond, you got almost 2% about a year ago. And if you bought a 10-year bond, you got about 3%. Now, 2 years ago, if you bought a 10-year bond, you were barely getting 1.5%. 1 year ago, you almost got 3%. So the 10-year bond doubled within a year. That was a pretty powerful development. But what about today? Whoa, that is what is called an inverted yield curve. And why is it called inverted? Well, it's because short-term rates are higher than long-term rates, which is not what you would expect. You would expect that if you're going to invest your money for a longer period of time, which basically means you're taking on more risk because you're putting your money away for a longer period of time, you should be compensated for taking that risk. So you should get higher yields the further out you go. That is not the case today. In the case today, where we are now, the 1-year T-bill is yielding over 4.8%, close to 5%. The 10-year is still right around 3.5%. Why would anyone buy a 10-year bond that yields around 3.5% when you could buy a 1-year bond that yields almost 5%? Well, that's because the 10-year bond traders think that eventually this yield curve will start looking more normal, meaning short-term rates will have to come down. Why will they have to come down? They will have to come down if the Federal Reserve actually begins cutting interest rates. And why would the Federal Reserve do that? They would cut interest rates if the economy is going into a recession or in a recession. That's one of the ways the Federal Reserve can stimulate the economy, by cutting the borrowing costs. So this is what we're dealing with today, and this is what has caused a lot of stress in the markets, and this is actually what caused, certainly Silicon Valley Bank to fail, because when interest rates come up so high and in such a short period of time, all the bonds that they bought a couple of years ago at rates close to zero really aren't worth very much. And they were forced to sell those bonds at those lower rates, and that caused a lot of problems. So why do we care if the yield curve is inverted? And why do a lot of people talk about it when they talk about recessions? Well, that's because the inverted yield curve is a very reliable indicator, a predictor, I should say, of a recession. So, and depending on who you talk to, what's inverted. I mean, our preferred method, or a lot of people's preferred method, is of measuring inversion is looking at the 3-month Treasury bond yield or bill yield versus the 10-year Treasury bond yield. So this chart actually shows the spread between the 3-month T-bill and the 10-year T-bond since the mid-1950s. So anytime that the blue line is above zero, that means the yield curve is not inverted. It means the 10-year Treasury was yielding more than the 3-month. Anytime this blue line is below zero, that means the 3-month T-bill was yielding more than the 10-year Treasury bond. And that means the yield curve was inverted. So as you can see here, every time the yield curve inverted, it basically, it had the yield curve inverted before the last 8 recessions we had. So for example, in the late 60s, it inverted and we had a recession right here in the early 70s. It did so again in the mid 70s. It did so again in the late 70s. And all of that was a recession followed those inversions. So recessions are indicated by these gray bars on this chart. Obviously, the yield curve inverted before the great financial crisis in 07 and 08, and this gray bar is that recession. The yield curve inverted before the recession we had as a result of the pandemic, which is this very thin gray bar. And why is that bar so thin? It's because the recession we had as a result of the pandemic was very brief. It didn't last very long. And here we are again, inverted. So the question is, when are we going to have the recession? When are we going to fill in a gray line on this chart? Now, while the inverted yield curve is an excellent recession predictor, it's not great in terms of predicting the actual timing. And that's because recessions can start anywhere from 4 to 21 months after the yield curve inverts. So the logical question is, well, how long has it been since the yield curve inverted? Well, the yield curve inverted in October of last year. So that basically means it's only been about 6 to 7 months that the yield curve is inverted, which still means we could have a recession tomorrow, but it also could mean we might not still have a recession for another year plus. So that's why, yes, an inverted yield curve means we're going to have one. It just doesn't tell you when we're going to have one. So that's why it can be a little frustrating. Okay, so one of the other things that's happening right now is that we had a very abnormal situation a few years ago with the pandemic, right? So we had an incredible amount of excess savings that were built up during the pandemic because people couldn't spend their money, right? So the green line here showing from October of 2019 shows the personal savings rate. You can see how it spiked with the onset of the pandemic. And now, obviously, it has slowly been coming down because people are not saving anymore. They are spending. But these blue bars here represent the cumulative total excess savings that consumers had as a result of the pandemic. So at one point, it was close to $2 trillion, right? and now it is coming down, and now it is just over $1 trillion. Still a lot of excess savings out there, and that has actually supported the economy. And more importantly, it has also promoted inflation, because all this excess savings has allowed people to continue to spend and buy things despite the fact that everything is more expensive. That makes the Federal Reserve's job a lot harder, because it's hard for them to bring inflation down when you have all this excess savings that are still in the system that people can use. Now, if you follow this chart down, I mean, this is kind of a general prediction of where that savings rate will go. So basically, this is predicting that all those excess savings will be spent down by basically October of next year, which means that no more friendly environment for consumer spending. So that's kind of a bit ominous when you think about what the impact that might be to the economy. And I think we're already seeing some of that impact now in terms of a lower savings rate and as getting much lower. So something to keep an eye on there. So what is the market also looking at? Well, we always talk about how the market really cares about earnings, right? And actually, I just noticed, came across the tape, Amazon just reported earnings after the close of the market today, and they were awesome. Amazon stock is shooting up in the aftermarket as a result. Not too dissimilar to what happened with Facebook the other day. They reported earnings. They were awesome. However, that is not happening across the board. As a matter of fact, a lot of other companies are struggling a bit. And so it's been a mixed bag, probably bordering on negative for earnings reports. And basically, the estimates for earnings for the rest of this year are somewhat negative. And why is that? Well, that's because the market is expecting profit margins to decline. And why are the profit margins why are they going to decline? Well, it's because people have to, input costs are a lot more expensive. And people are a lot more expensive. Corporations are paying a lot more to keep their people as well as to hire new people. And with the unemployment rate still hovering around record lows, people have job flexibility, and they also have the ability to demand higher salaries. Now, that's an interesting dynamic. We're going to dive into the unemployment, or rather the employment situation, a little bit more in a minute. But I do think that, in general, the earnings outlook for the rest of the year isn't wonderful, which might mean that the market might not do much more for the rest of the year. So something to keep in mind. Now, getting back to the labor market, it's still very tight, right? And why is it tight? Well, if you see what happened to our labor force in various cohorts, you'll see that the participation rate in the labor force actually got somewhat back to normal for younger age workers, but not the case for the older cohort or age 55 and up. Their participation rate is still well below the long-term average. And a lot of people feel like it may stay that way, that they may never return to the workforce. So, the labor force grew by about 2 million people since February of 2020. And, that usually is a good thing. But the participation rate of that labor force has not recovered because of that older cohort. And so that is putting a lot of pressure on the supply of labor, which a lot of people don't think is going to change anytime soon. So this is kind of a busy chart here. This looks like, kind of like an EKG or like a heartbeat, but it's pretty interesting to look at, because what we have here on the bottom or the light gray or green line, again, I'm colorblind, but it looks a little light green to me. That's the job openings rate. And the black line is the unemployment rate. So what's fascinating here is that usually anytime you have a declining job openings rate, unemployment goes up. It's almost a mirror image. Job openings decline, unemployment goes up. But here, and this goes back all the way to the 50s. And by the way, these gray bars also represent recessions. So in other words, job openings tend to decline before a recession. Obviously, unemployment starts to creep up, and then we get a recession, and then the unemployment rate dives back down once the recession is over. So where are we today? Well, this is where we are. We have this incredible decline in job openings, but we don't have a corresponding rise in the unemployment rate. So a lot of people in the marketplace are really puzzled over this. You know, how is that possible? Because that never holds true according to history. So what's behind this? Why is it different this time? Well, the answer is that the jobs workers gap, meaning the difference between labor demand and labor supply, reached a record high following the pandemic. Basically, a 3.7%, it reached a record high of 3.7% following the pandemic, and it really hasn't come down. So we still have what's known as a job workers gap. So despite the fact that we have that drop in job openings, the ratio of unemployed workers to job openings is problematic. And that's probably going to be the case for the foreseeable future, because people who lose their jobs aren't having much time finding another one. So in the presence of that steep aggregate supply curve, that means that output growth, which is very correlated with employment growth, may not slow much even if demand growth slows. So you got to get out your textbooks for all this. This is kind of, economics 101. But that is a very interesting phenomenon. So let's dig into that. So why does that matter? What do we care? What should we be afraid of? Well, when you have falling demand, that usually drives down inflation without driving down unemployment. And that's actually kind of what's happening right now. That's what the Fed wants to see. That's what investors wants to see. So we're seeing kind of, we are seeing inflation come down. We're not seeing unemployment go up. And the market's like, well, this is great. Maybe the Fed is organizing or orchestrating that perfect soft landing where they're managing to slowly but surely tame inflation without kind of breaking the economy and causing unemployment to spike. The problem is that eventually aggregate demand will fall enough and cause output to fall that unemployment rate will inevitably start to rise. And so the fear here is that just as everybody's thinking, this is great, the Fed achieved a soft landing, we're not going to have really a bad recession, that's when you get hit with a recession that you're not prepared for. So take a look at this chart. This is showing that the unemployment rate usually is either moving up or moving down. It doesn't usually just go sideways for a while, right? So this is showing the unemployment rate since the 1950s. It's either going up or it's usually going down. Now, very rarely, like I'm circling here, does it kind of grind sideways. However, when the unemployment rate drops to very low levels as it is today, that is when it can putter around sideways for a certain period of time. And usually it can putter around for about 2 years. So I think this is fascinating. If you look at this, this shows the unemployment rate prior to the last 5 recessions. And basically it shows that when the unemployment rate wasn't really moving up or down very much, right? So basically almost like less than, 0.6%, it can do that for almost 2 years, on average, almost 2 years. And that happens almost without fail before a recession begins. So where are we today? Well, the unemployment rate hasn't really gone anywhere for just over a year. Now, if this holds true, that means the unemployment rate could still grind around near record lows for another 9-8 months or so before a recession begins. So the question is, will this hold true? No reason to think it won't. Perhaps it'll be a little shorter this time. So that is something to really keep an eye on, because we're already over a year where the unemployment rate has just been grinding sideways. And so why do I say equity returns are typically weakest when the unemployment rate was low? Well, actually think about last year. Last year, the unemployment rate was pretty much grinding around at the lowest level it's been in a while. And last year was a horrendous year for the equity market. So don't just take my word for it, but look at this chart. This chart actually shows what the average return was in the S&P during various unemployment rate regimes. So when the unemployment rate was less than 4%, that's when you had the lowest average annual returns of the S&P. Interestingly enough, when you had super high unemployment, that's when the S&P returns were the highest on average. And why is that? Well, that's because usually when you had very high levels of unemployment, that was when the recession was at its end. And the market always anticipates that. And usually the markets start to rally as you start coming out of a recession, not before. So what does all this mean? And what does this mean for investors? And should we take all this with a grain of salt? Well, yes, as the saying goes, it's actually time in the market, not market timing. It's very hard to say, oh, I think things are going to be bad, so I'm going to come out of the market, and then when to jump right back in. Very difficult to achieve. So I think this is a fascinating chart because this basically shows that if you miss the 10 best days of any given year of market returns, your return on average drops by about 25%. So the average annual return of the S&P over time, and this goes back, for I think about 30 years or so, 40 years. The average annual return of the S&P has been about 10.5%. But if you miss the 10 best trading days of any given year, your return drops to 8%. If you miss 40 of the best trading days of the year, so just a little over a month, your return drops to less than 4% on average. Your returns are absolutely decimated. And then if you're out of the market for about 2.5 months, the best 2.5 months of trading, your return is basically zero. The point here is timing the market is incredibly difficult. Don't do it. Just rely on us to make sure that you have the proper asset allocation given the current situation. Okay. Another good point here is that why we've been talking a lot about bonds and why I'm about to say that we're still increasing the allocation to bonds. This actually shows the ups and downs of the S&P. The black line shows the annual return of the S&P. The diamonds, the green diamonds show how much it dropped that year. Even though it might have dropped that far, that means it didn't end the year that way. The black line shows actually how it ended the year. And the blue dots show what the average fixed income return was for that year. So kind of the point here, and this is why do you want bonds in your portfolio? Well, you want bonds in your portfolio because even when stocks are doing some wild gyrations, bonds don't. Bonds tend to stabilize your portfolio and still deliver decent, if unexciting, returns over time. And that's very important in terms of dampening the volatility, right? So that's why we always want to make sure that we have the proper allocation between bonds and stocks, given whatever your risk profile is, right? Okay. So after all that, what are we really paying attention to? Well, I mentioned earnings. I think we really got to pay attention to what happens for earnings for the rest of the quarter. The first quarter earnings are still rolling in. We've seen some great earnings from tech, not so great earnings from finance, from the financial sector, mixed bag in industrials, not so great in real estate. So we really need to see what plays out for the rest of the quarter as the earnings reports come in. More importantly, though, we want to see, are there going to be any more cracks that show up in the system, like kind of this mini banking crisis that we've already are living through right now? What is the Fed going to do? Are they going to raise rates again on May 3rd? If so, is it going to be 0.25%? Are they going to actually let us know, is that it? Are they going to say maybe not? The market's going to be focused on that because the short-term rates are what are really driving a lot of people's investment decisions right now. How about international? International stocks have been doing great. They've been outperforming the US. Is that going to continue? Perhaps, and it's definitely going to continue if the US dollar continues to weaken, because when the US dollar is weak, international stocks, that's kind of a tailwind to international stock returns. So that's another thing to keep an eye on. We talked about unemployment. I spent a lot of time on that, but I do think that dynamic right now is very unique and very important. I do think it's going to start going up. It's just a question of how fast it's going to climb. and when is that going to start? Bonds, of course, bond yields are probably past their peak. And the question is, how much lower are they going to go if the Fed signals they're done raising rates? Obviously the yield curve is inverted. The problem is if you load up on just short-term bonds right now, well, what happens a year from now if the curve starts to uninvert? Because you're going to have to take the money that you get back from those short-term bonds and invest it in something. And if that something is not that, if the yields have dropped, that something may not be as attractive. So that's one of the reasons why you don't want to necessarily only have short-term bonds, because they will mature in a very short period of time. And then you're going to have to do something with those proceeds. And you don't want to be stuck with with an unattractive yield situation when that happens. China's been an interesting story right now. China's economy has been actually doing pretty well, especially compared to ours. A lot of that is a result of them coming out of the pandemic, emerging from pandemic, I should say. So the question is that going to continue? Because they are the second largest economy in the world. And if they do start ramping up activity, that could be a tailwind for not just the global economy, but Europe in particular. And then, of course, even though it's really not in the headlines as much, the Ukraine-Russia war is still going on. That is anyone's guess as to when that bill will be resolved. But if it is resolved sooner than people think, and people actually don't think it's going to be resolved anytime soon, but if it is, that could be kind of a nice positive to the markets, because the markets are not expecting that. So what does that mean for portfolios? Well, first thing is that we are going to continue to increase exposure to fixed income. Again, bond yields are more attractive. I mean, certainly compared to 2 years ago, they're way more attractive. So we do want to keep increasing exposure to bonds. And in particular, we think the part of the yield curve that's really attractive is what I would call intermediate grade corporate bonds, because you are seeing some good yields without taking too much duration risk there. So we like that part of the yield curve. And you do get a little bump in yield when you invest in corporates, because you do take on some credit risk. U.S. Treasury bonds have no credit risk because they're from the U.S. Treasury. Corporate bonds contain credit risk because you have to worry about the creditworthiness of the borrower, and because of that, you get paid a little more for owning those bonds. We do want to be neutral, actually, to underweight U.S. equity, and that's because we do think a recession is coming. We don't necessarily know when, and we don't think it's going to be that bad, but we don't expect U.S. equities to do much for the rest of the year. So that being said, what do we do if we're underweighting U.S. equity? Well, we're probably going to overweight a bit international equity. Again, valuations internationally are more attractive. Dividend yields internationally are more attractive. The earning situation internationally is more attractive. And again, we may have that dollar weakness tailwind, which will also support the earnings that are coming out of international stocks. So those are the things we're doing with the portfolios. Hopefully that makes sense. And with that, we will open it up to some questions.
All right, thank you, Steve. That was another great presentation. Like Steve said, if anyone has any questions, please submit them now. We did get a few in. So first one for you is, can you tell us a little bit about, I know you touched on this, what's going on with First Republic Bank? There's a lot of headlines. I'm sure we've all been seeing about that. And what is the likelihood it's also going to go under?
Yeah, so, one of the reasons that you're seeing stress in First Republic Bank is because First Republic Bank had a fairly unique business model. And I'll take a step back and talk about, Silicon Valley Bank. They had a unique business model too. And what was that? Well, they were very concentrated in lending to the tech sector. So when you are very exposed to any one given industry and that industry goes through some stress, well, that can cause some stress on you as the lender to that industry. And that's kind of what happened to Silicon Valley Bank, among other things. But First Republic is similar in the sense that First Republic is known for targeting very high net worth individuals. And First Republic was also known for giving those high net worth individuals very attractive jumbo mortgages. And why did they do that? Well, they did that because those high net worth individuals were great credit risks. there was really no danger of those individuals defaulting on their loans. The problem is, and by the way, why do high net worth individuals like to take out big mortgages? Well, if you're a high net worth individual and you pay a lot of taxes, one of your biggest tax deductions is your mortgage interest. So if you can get an interest only loan for a good chunk of money from First Republic at a very attractive rate, and you can take that proceeds and invest it somewhere else and ideally make more money than what you're paying for the interest rate on that mortgage, that's a great deal. And a lot of people were doing that, and First Republic was facilitating that. So now First Republic has all these massive jumbo mortgages on their books that are really not worth much right now because interest rates have come up so fast that if they're sitting on mortgages that have a 3, 4, even a 5%, yield, well, when mortgages today are 6, 7, 8, no one wants to buy those mortgages. And when people are pulling their deposits out of First Republic, and First Republic is forced to sell those mortgages, they are selling them at a massive loss. And that is obviously causing them a lot of stress. And so that is one of the reasons why First Republic Bank is in trouble. Now, it remains to be seen what will happen. The FDIC may eventually have to step in like they did with Silicon Valley Bank. That's usually when they have to become the lender of last resort. I don't think anyone wants to see that happen. It may be that someone buys First Republic before that happens because their stock has plummeted. Maybe someone thinks they're an attractive buy right now. But again, whoever buys them is going to inherit a large book of loans that really aren't worth that much anymore. So it's really tricky. A big bank consortium has already pledged $30 billion in support to First Republic. That consortium was led by JP Morgan, among other big banks. And why did they do that? Well, they did that because if the FDIC does end up stepping in to save First Republic, well, guess who the FDIC is going to charge for that saving action? It's going to raise the fees that they charge all the other banks that participate in the FDIC insurance program. So that's going to end up costing them money anyway. So that's one of the reasons why a lot of the big banks kind of tried to step in and say, hey, can we actually help you since we don't want you to go under because it's really in no one's best interest. So First Republic's obviously a fluid situation, pretty complicated, but at the end of the day, a pretty unique bank with sort of a very unique asset and liability mix, which is not really helping them in today's very odd inverted yield curve interest rate environment. So that is kind of what's going on with First Republic Bank.
Yeah, interesting. Definitely very insightful. And then another question we got, is kind of funny, is what will it take and when will the food prices come down? Maybe you can weigh in from an economic perspective. I know inflation was, a hot topic for a while. So I don't know if you have any thoughts on that.
So if in general, we talk about like a food crisis, I mean, what we're really talking about is basically like shortages, and also the fact that inflation has been high, and therefore you go to the supermarket and you go shopping for, whatever it might be, eggs or ground beef or even cereal, and it feels like you're paying double than what you paid like a year and a half ago or so. And that's kind of disheartening. Now, certainly the Russia-Ukraine war did not help, because Ukraine was one of the largest exporters of fertilizer being used extensively, obviously, in the farming industry, which of course is what's behind the production of a lot of that food that we eat. So that didn't help. And, that exacerbated the price inflation behind that, because we had sort of fertilizer panic there. But really the story is the Fed going to be successful in bringing inflation down? And they have brought it down somewhat. I mean, I think I read the other day that egg prices actually did come down a bit. But I think the answer is they're not done yet, and inflation is still relatively high. Certainly a heck of a lot higher. I mean, we got used to having very low inflation for a long time. Ever since kind of the great financial crisis, inflation has been running at 2% or less for give or take 15 years. And then when inflation, which seemed like overnight, spiked up 8-9% and is now still hovering well above 5%, that's not ideal. And that's what the Fed is struggling with. How do they get that inflation down, right, without causing the economy to quote unquote break, which would mean skyrocketing unemployment, a big economic slowdown, lots of layoffs, corporate profits decline. That's what happens when the Fed breaks things. Corporations pull back, they stop spending, people get laid off, earnings aren't so good, profit margins collapse, the market hates that, and then the cycle repeats as we come out of that. So, the real question is, how much more does the Fed have to do to bring down inflation? I personally, and this is just my personal opinion, I actually think the Fed has done enough. I think they just need to hold. I think they need to be patient and let those higher rates have their desired effect of slowing things down, because I do think things are already slowing down. And we just saw that with the GDP print we saw for the first quarter, slower than people thought. Not negative, but slower. So the problem is the Fed kind of still has this, political pressure to bring prices down, because many people out there, such as whoever asked that question, are saying, "Oh my God, when are these prices going to come down? I'm sick and tired of paying these high prices, because if I have to pay these high prices forever, my money's going to run out." Right. So that's kind of the pressure that exists, that the Fed is wrestling with. No easy answer to that at all. And that's why we have kind of the chaotic markets that we're seeing right now.
Totally. Yep. Makes sense. All right, great. Well, if no one else has any other questions, that wraps it up for today. I just want to remind everyone before we close, there will be a follow-up survey that will come up in the browser when we end the webinar. Just gives you an opportunity, like Steve said, provide some feedback and also topics or questions you guys have for our upcoming presentations. We do these quarterly. So we'll be back in front of your screens in a couple weeks or so. So Steve, any closing remarks?
No, really. Thank you, Katie, for helping to organize these webinars, and thank you all for listening. I hope it was informative, and please, feedback is good. Let us know. And until next time, see you soon.
Great. Thank you, everyone. Have a good day.